Hey credit warriors, welcome to the show. And we have a story that came seemingly out of nowhere, at least for me, and that is that Capital One is buying Discover Financial Services, the bank behind the very popular Discover It cards, and that's one of the top cards I recommend for people new to the credit card game. In fact, I also do sometimes recommend the Capital One Platinum card for people with, low credit scores or who are just starting out, although Capital One in recent years has been targeting more the mid to high tiers with their very popular Venture X card. Anyway, let's read a little bit of the story. So it was the Wall Street Journal that broke this news, and the deal is supposedly worth $35 billion. Here's part of their article. Discover shareholders are set to receive 1.0192 Capital One shares for each Discover share, representing a premium of about 27% based on Discover's closing price Friday. After the deal closes, Capital One shareholders will hold roughly 60% of the combined company, with Discover shareholders owning the rest. The interesting thing is that Capital One is not just acquiring Discover's credit card customers, but they'll also get their savings accounts, bank accounts, and most crucially, their credit card network. You see, Capital One cards run on Visa or MasterCard networks, but Discover has its own network, the Discover Network. If you own both the issuing bank and the network, you can take home a larger cut of the merchant fees that get paid every time the card is swiped. According to the Wall Street Journal, Capital One will switch some of its cards to the Discover Network. I'm not sure which ones, but apparently they will. Also, in case you are wondering if the Discover It card will now become the Capital One It card, apparently not. As reported in the Journal, Capital One also plans to maintain the Discover brand on the cards and network, assuming regulators sign off and the deal is consummated. So as far as what this means for points and miles and other credit card rewards, we don't really know anything apart from that the Discover brand will remain and some Capital One cards will switch to the Discover network.
All right, so I just wanted to give a quick flash of what's going on. This was posted back in February of last year. Okay, so this merger is over. All right, it's a done deal, y'all. So welcome back. The other day, I told you all that we would be right back here, right, to talk about what to do with the information of knowing that millions upon millions of Americans are in financial ruin and facing millions in debt collections thanks to companies and businesses like Klarna, Afterpay, and Affirm, right? And so at the end of it, I suggested that we all take the information and use it to our benefit somehow, right? Because what good is having the information if we are not going to actually do anything with it or use it to our advantage in some kind of way, right? As investors, what point is it in having this information if we ain't gonna do nothing with it? So I told you that we would be right back here covering exactly what stock to purchase in order to capitalize on people's bad financial decisions. And it sounds harsh, okay? But again, in the last video, I told you I would rather much be on this side of the fence, on the receiving side, than the side that's under duress. And because Klarna, who was formerly set to IPO sometime earlier this year, has apparently been stalled now due to the massive number of consumers not paying their debts. And so because we can't exactly invest into Klarna because that IPO has been pushed back, I have an alternative solution for the time being that I believe will yield my investing account great dividends going forward. And so I mentioned both Visa and MasterCard, okay, in the last video. Both Visa and MasterCard. And although both of those companies can be bought in the stock market, you can go look them right now. I believe Visa is ticker symbol V. MasterCard is ticker symbol M. It's not MO. Is it MC? I don't know. Look it up. But because they can both be bought in the stock market, however, neither of those IPOs will be the focus of today's video. Instead, we're going to take a look at another publicly traded company. Obviously, you already know what it is because You just watched the beginning of this video, and I'm going to tell you why I'm choosing Capital One, ticker symbol COF, over the others. Starting with the fact that Capital One made a huge acquisition back in May of this year. They closed that deal, the deal that you just saw I'm talking about, and spent over $35 billion to acquire Discover Card, okay? Meaning all of their accounts, all of their clientele, their entire customer base, everything now belongs to and falls under the umbrella of the Capital One business, which has effectively made it the largest credit card company in this country and the sixth largest U.S. bank, okay, by assets across the United States. And you heard him say that Discover was one of the easiest cards to get. So they don't want to get rid of that customer base. They want to capture the best of both worlds, and they're able to do that by keeping it separate. This was a major move, okay, that I am sure was made very strategically, okay, considering the hefty price that they just paid to absorb their entire brand. This was done very, very strategically, y'all. So every Discover Card user has effectively become a customer of Capital One overnight, okay? Now, in addition to this huge acquisition, which I looked across all three companies, okay? When I looked across all three companies, their dividend stock payouts in particular, Capital One stood the tallest with the highest and the largest dividend payout percentage, sitting at 1.12%, which comes out to roughly 60 cents per share at the time of this recording. And, that's not huge, right? It's not gargantuan, but the dividend, like the others, is paid out quarterly, and it's higher than the other two companies, Visa and MasterCard. Now, there is something that I noticed that isn't necessarily a cause for concern, but is a factor that people may want to consider nonetheless, okay? And that is the fact that there is a negative share buyback percentage attached to Capital One right now versus the other two stocks, which both have positive buyback percentages. Which, if you don't know, really quickly, a negative share buyback essentially means that the company is not currently reinvesting money back into their shareholders or itself through stock buyback programs, right? They're not actively buying back shares in their own company, because what happens when a company repurchases its own shares is that it decreases the amount of open shares on the market, which then makes every share that's out there that's held by its investors more valuable, because the pie just got a little bit smaller. So that's why people like the share buyback programs, right? But this isn't always a bad thing, because there can be multiple reasons for a company having a negative share buyback percentage attached to their stock. For example, they could be focused on making other companies or making other ways. They could be focused on making other ways to increase the value of their core business through something like acquisitions, which we just saw, right? Which is just a fancy way of saying the company went out and they made some expensive purchases. They bought something, which usually means they absorbed another business or another company and have added their portfolio to their own. They've made their company and their brand that much more marketable and that much more bigger through those acquisitions and those purchases. So Capital One just became the largest brand for every consumer credit card around the country. Okay. They currently have the highest paying dividend out of the three. And because of the moves that they've made recently, I believe that they also may have the most upside potential in stock appreciation, giving me, the investor, the best of both worlds, right? Holding a stock that pays well enough, or at least has a respectable dividend, and has the potential of a large or good amount of growth and upside potential is a dividend investor's dream, y'all. Okay. It's a dividend investor's dream. So Capital One is also currently the cheapest out of the three major credit card stocks that you can buy right now. And when you look into their fundamentals at the positioning and at the positioning of this company financially, they are in a very healthy spot, okay, with free cash flow. They've also got plenty of money to pay out to their shareholders through dividends, and their debt is very manageable. So for me, this one is pretty much a no-brainer for my particular dividend portfolio, which is why today I'm investing $25. Okay, nothing huge, nothing major. $25 into Capital One, ticker symbol COF. Okay, I'm investing $25 today, and I think we are definitely, we're definitely beyond the markets. So the markets are closed at this point, but it'll go on, and that purchase will be made. Today's Friday, so it'll be made Monday, right? But $25 into Capital One. I think I'm gonna make an investment into Capital One every 2 weeks, starting today. Every 2 weeks, I'm going to make a $25 investment into Capital One and just let this thing grow, because I do think Capital One is a position that I do not mind holding for the long term, right? For the long term, I can get some of those great dividends, and hopefully we can go ahead and capture some amazing growth in the future down the road as well. Really quickly, before we get out of here, this video ain't gonna be long, y'all, I promise. You can see that stock price sitting at $221.22. You might say, geez, that's pretty hefty. Again, y'all, it's the modern age. You can invest as little as $5 if you want to into Capital One. And if you have a Cash App investing portfolio, you can invest as little as $1 if you want. Okay, it's all up to you. Partial shares are here, and they're here to stay. So you can invest however much you want. Me, I'm doing $25 today, and I think I'm going to do $25 every 2 weeks starting today. But again, you see that stock price, $221, which is it's the cheapest among Visa and MasterCard. I believe MasterCard is almost up to $600 a share by now. Visa is around $350, hovering somewhere around there. And if you really want to look at their month chart, you can see that people are watching. The shareholders are watching. They understand what's going on. Year to date, they're up 24%, y'all. Year chart, they're up nearly 60%. They have been killing it, y'all. I'm telling you right now, okay? Listen to me. Investing in debt is one of the smartest things that I think that I can do. Okay? As a common everyday worker, I go to work just like y'all. All right? I work a 9 to 5. Well, technically, it's not a 9 to 5. I work much longer hours than that. But I am an average everyday American worker just like y'all. And I believe that one of the smartest things you can do in the stock market is invest in debt, y'all. Invest in debt. Again, that's what gives us a leg up. Knowing the information that we just learned about Klarna in the last video that I did, right? Learning about how much debt Americans have, about how much debt people have and how much outstanding debt that they have. Well, we can't exactly invest in Klarna right now. But you know what we can do? We can certainly invest in credit card debt, which is through the roof. I don't know if you've been paying attention, but credit card consumer debt reached over $1 trillion, 1 billion last year. I don't remember. Don't quote me. But it's something astronomical. It's an astronomical amount of money that Americans owe back to credit card companies. So I believe one of the smartest things you can do is invest in that debt, y'all. Invest in the debt of other Americans. Let them pay you for change, right? Instead of us shoveling all these monies to these companies and these credit cards, let these credit card companies pay us for a change. And so I believe with this investment, I believe that going forward, this investment is going to be a great one. I can't wait to see how this pans out down the line. I'm going to look to hold on to this for years and years to come. You all do. what you think is necessary for your own portfolio. Please do make sure that you go and do your own research, look these things up, manage it well, and figure out if this is an investment that you would like to make for yourself. Last but not least, we're going to go over to the forecast and see what they have to say. Out of 15 analysts that covered this stock, they have a consensus rating right now of buy, which is very close to strong buy, and with an average target price of $236.73, which is definitely what it is right now. And they forecast a 7% increase over the next year, okay, with a low target of 184 and a highest target of 275. So listen, that's going to do it for me. We did it. We did it, y'all. We came, we saw, we got it done. It's time to go, right? Check it out. Let me know if you are investing in any credit card companies if you have any that you're holding in your dividend portfolio or in your stock portfolio, whatever you have. Let me know if y'all are investing in consumer debt. Let me know if you have any credit cards in your stable, and drop a comment down below. Let me know that you mess with me. I appreciate each and every one of you that took the time out to watch this video, and I will see you all back in the next video. Later, y'all.